First off, during the trading day, the number one rule you have to keep in mind is the less amount of decisions that you can make during the trading day. In other words, the more things that you have thought out before that day opens, the better off you are. You don't want to be having to make multiple decisions during the trading day. So very first off the bat, you must have your unit size predetermined. Are you trading 5 lots? Are you trading 10 lots? Are you trading 2 contracts? So forth. I firmly believe in deciding on your unit size and keeping an even bet size, because I don't know in advance which the good trades are and which the bad trades are, and invariably if I start doing a 2 lot where it's scariest, that'll be the winner, and if I do a 10 lot where it looks like it's a slam dunk, that's going to be the loser. So you must keep an even bet size in order to start achieving some type of consistency of numbers. The second thing, how do you exit? Exit strategies really should be predetermined, and they are set according to the initial trade setup. For example, in most of our quantitative testing, about 75% of the trade setups test out best exiting for a small piece only. By that, I mean, for example, saying, okay, I'm going to take profits at 1 ATR, 1 average true range function, or a test of the high, or a fixed target. Only about 30% at best, more like 25% of the initial trade setups justify a trailing stop management and exit technique. Now, it doesn't mean that once you're in a trade, you can't tighten up the stop to cinch profits, and that's something we'll spend some time at the end of this presentation, because it is very important if the market makes a move, you pull your stop up to tighten in the profits or lock in the profits you made. That is different, though, from a trailing stop methodology to let it take you out of the trade. Examples of where we would use a trailing stop mentality could be, for example, with a trend following system. The goal there is to try and capture a trend if there is one. There was a preconditioning structure that led to the trend, and our goal is to stay with the trade and not take profits too soon. The majority of time what you'll find is that the shorter the time frame that you are trading on, the less justification there is for trailing a stop. The reason being, the shorter the time frame you go down to, the more you are trading in market noise. To give the extreme example of that, if you were a floor trader in the pits and your average trades are going on for 3 minutes, and of course we know what happened to the pits, they're not the same anymore, but if you were so, your job is you're buying on bid, trying to sell on offer, you're not trailing a stop on the trade that you just bought. That would be an extreme example. So floor traders, or even the automatic market maker systems that you see with the black box algorithmic trading that is so dominant nowadays, which accounts for up to 40% of the volume out there, if you're not aware of that, buys on bid, sells on offer. So if you are a short-term trader, especially a day trader, you need to be buying on bid or selling on offer at least 50% of the time. If not, what will happen is the friction, or what they call the VIG, the difference between the bid and the ask, as well as your commission costs, will overcome the potential profitability. Again, with that said, there are specific patterns, such as a breakout from a long extended coil, that would justify trailing a stop. But you need to have done your homework ahead of time to know which trade management strategy is appropriate at that time, and then not to second guess yourself and say, oh dang, I should have trailed a stop on that one, and so forth. Now we're going to start talking about market environments. The less volume there is and the more noise there is, the more critical it is to work a bid or work an offer for your initial entry. If you missed the trade, so what? Let it go. You're in a noisy environment, and the odds that you're leaving a big win on the table are remote. However, there are other types of market environments which I call urgent market environments. And in an urgent market environment, that is one of the times that you can use a market order to enter. And the initial goal in an urgent market environment is just to get the trade on. Okay? If you try and get cute and price it, the odds that you'll be left in the dust increase greatly. A trend follower, their main job is to get the trade on. They're going to pay up. It doesn't matter. It causes a lot of slippage, and you'll see these big, huge bars on breakouts where there's very liquidity because this group of market participants recognizes the importance of getting that trade on. It's like first come, first serve.